And welcome to Investment Banking University, where we teach you how to become an investment banker. Today we're talking about the very important topic of valuation methodologies that are used in investment banking and private equity. So the first valuation methodology that we're going to be talking about is the public company valuation. So this ultimately means that their shares are traded on a public exchange, and thus we are going to be arriving at a valuation for the company based upon that. So the the formula is TEV equals the market value of equity plus debt, preferred equity, plus minority interest minus cash. So the market value of equity is found in the balance sheet, the debt is found in the balance sheet, the preferred equity is found in the balance sheet, the minority interest is found in the balance sheet, and then the cash is found in the balance sheet. And TEV is equal to share price times, or where share price is, times fully diluted shares outstanding, including warrants and options. And so since cash is already counted in the valuation of the market value of equity, we do not want to double count. So the second methodology is known as comp companies, and this is known as a market methodology, and it's also known as trading comps. And so the management team ultimately gives you 1 to 2 year projections or equity research comp reports to get forward multiples times revenue or times EBITDA. Which may be used as the basis for this valuation. So you can get comps from the general overview, as it will discuss the target comps in the 10K. Find comps with good multiples to then tell your story to the marketplace to then get a certain valuation. So the first step in doing this methodology called comp companies is to select a universe of comparable companies, choosing 7, 8, 10, and we're going to ultimately get their 10K and 10Q analyst reports to ultimately get to TEV and to each comp, and then divide by the line item to get the multiple. And then we're going to, number two, the second step is we're going to locate the financial information, the 10K, the 10Q analyst reports, and then we're ultimately going to spread the key financial information in ratios and multiples to calculate TEV, which we talked about in the first step. And we're going to be using the treasury stock method, which is the exercisable options outstanding times the difference between the share price and the strike price over the share price. And then ultimately we're going to be benchmarking those comp companies to get the multiple that the company is trading at for each metric for each comp, to then get to the mean and the median for the comps, which will then be used to determine an implied valuation. We're going to be multiplying the mean and median multiple to get to the revenue and EBITDA based valuation for the target company. So the key important things here to note are the better the company, the higher the multiple and the better valuation you get. So in investment banking, private equity, and corporate finance, you need to know about comp companies and transaction comps. So here are the comps for your sector is ultimately what you're going to be stating to them. So the higher multiple is because you're operating in a better market or better operations, and the multiple tells you which company is better. Margin analysis, which we'll talk about later on in the course, ultimately tells you why they are better. So this key sell side question is, which comp would you use to guide your potential buyers? The third valuation methodology, which is very similar to comp companies, is actually called precedent transactions or comp transactions. Comparable transactions. So we're going to be ultimately selecting a universe of comparable transactions. We're going to locate deal-related and financial information. We're going to need press releases of the deal, the 8K, the 10K, the 10Q, and ultimately what is the nature of the transaction? Is it going to be based in payment? Is it going to be based in stock, cash, or cash and stock? We're going to spread the financial information to get the multiples to get to the total enterprise value, and then the transaction market value of equity, the implied. And the fourth step is to benchmark the precedent transactions. Then the fifth is to determine the implied valuation based upon the information that we've gleaned from the comparable transactions applied to our target. The important things to notice here are 20 to 25% control premium paid, with the transaction multiple being an implied one based upon the valuation. So we determine whether the market is good or bad based upon whether people are paying good premiums, control premiums, for different acquisitions. So when a transaction occurs, we update the client on the latest transaction to show them the impact on the control premiums being paid in the implied multiple as well. So we point to the transaction comps ultimately that have the highest control premium is what we're looking for. The fourth valuation methodology that's used in investment banking is known as discounted cash flow, or DCF. And the first step is to spread historical financial statements. We're going to be inputting the historicals to derive historical ratios, trends, and variables. And these are the drivers of future performance, meaning the margins and growth rates are the drivers. And we're going to project financial statements, or pro forma, as well as do revolver modeling later on to link the income statement, the balance sheet, and the statement of cash flows. The second step is to project the free cash flow. The third step is to determine the weighted average cost of capital, i.e. the discount rate. So in order to determine the weighted average cost of capital, we're going to first have to determine the cost of equity, and we do so using the capital asset pricing model, or CAPM, which is equal to the risk-free rate plus beta times the difference between the risk of the market risk as well as the risk-free rate. And so where RF is equal to the 10-year treasury, the market risk premium is the difference between RM and RF. And we are actually going to refer to Ibbotson on that. And ultimately, this is the S&P returns over 70, 80, or 90 years. The beta is average beta of the comps to unlevered median and mean of the comps, the unlevered beta. And this should be 0.5 to about 2.5. And then we're going to be using the 2-year or 5-year betas, taking out capital structure and re-levering to actual capital structure of the target company. With beta, we are putting capital structure on an unlevered beta, mean, and median of comps to calculate the weighted average cost of our own target company that we're working with. For the cost of debt, we're going to be using the weighted average tranches of debt, which are tax affected, found in the 10K, and then the rates are actually going to be found in the notes. So if it's a private company, we're going to have to get the tranches of debt from the client to get the rates, or we're going to go to the DCM within the investment bank to get an approximation. And so this chart ultimately shows how corporations determine the optimal use of debt by minimizing the rate, so not by having too little of debt or too much of debt. So the cost of equity is 20 to 25% in the private market, so no use of debt is an inefficient use of capital, and so we're ultimately trying to optimize the debt to equity ratio to minimize the cost of financing, or the discount rate. In the next step, we are going to determine the terminal value, and this is going to be based upon an EBITDA multiple, which is going to be almost 80% of the company value. So the terminal value is equal to the LTM multiple from the comps times the EBITDA of that time period for the target company. So the perpetuity growth rate should be about 2.5 to 3% and should not be larger than the GDP of the company, of the country. That would not make sense. So we are ultimately, in the final step, we're going to calculate the net present value, and we're going to have the implied valuation based upon that. So those are the different. Be learning in the course how to become an investment banker at Investment Banking University, and you can actually pick up the free book Investment Banking, which talks about these in greater detail and gets into the actual modeling at investmentbankingu.com. So we look forward to seeing you at our online course, at our weekend course, or our month-long training.